Hey, it's your mate from TheMoneyMad. Ever looked at the stock market and thought, this is way too complicated? You're not alone. In 2026, with AI stocks going crazy and everyone talking about the next big thing, most beginners lose money because they follow hype instead of rules. Today, I'm breaking down the 7 timeless rules that smart investors actually use. Stick around till the end. I'll show you a simple beginner plan you can start with just £50 a month. Rule number 1. And honestly, this is one of the most powerful rules you'll ever learn. Buy stocks when they're cheap. Now wait a second. Don't misunderstand this. I don't mean cheap like a random penny stock that costs 5 pence. No. I mean cheap compared to what the company is actually worth, its real value. Let me make this super simple. Imagine this. Yesterday, you walk into a shop and see a pair of brand new, genuine designer trainers for £200. You think, a bit expensive. Now today, you walk back in, same trainers, same quality, same brand, but now they're on sale for £120. You'd instantly think, wow, that's a bargain. That's a deal. I should grab that. The trainers didn't change. Only the price changed. Stocks work exactly the same way. In early 2026, we saw massive AI companies dip. Prices dropped. People panicked. Everyone started shouting, "Tech is dead. It's over." But the smart investors? They stayed calm, looked at the numbers, looked at earnings, and realized something very simple. The companies didn't get worse. The price just went down, which means they were finally on sale. Now let me slow this down even more, because this is where most beginners go wrong. People see a low price and assume it's a good deal. But low price does not mean good value. A bad company can be cheap and stay cheap forever. A great company, temporarily discounted. That's where opportunity lives. So always ask yourself, is this company strong? Is it just temporarily down? Because smart investing isn't about guessing. It's about understanding what you're buying. Look at the PE ratio, the price to earnings ratio. If a strong company like Unilever or a global giant like Apple is trading lower than usual, that's your signal. That's your discount tag. That's your sale sign. Don't buy hype. Buy value. Rule 2, and yeah, this is the one people really don't like. Sell when they're expensive. Let's be honest. You buy a stock, it goes up 40%, maybe even 50%, and suddenly you feel like a genius. You start thinking, if it went up 40%, it can go up 400%. No, stop right there. Don't fall in love with a stock. It's not your pet. It's not your friend. It's not your identity. It's just a tool to make money. If the price runs way ahead of the company's actual performance, that stock becomes overvalued. And this happens all the time, especially with trend stocks. Here's a simple warning sign. If your Uber driver, your neighbor, and even your grandma are all telling you to buy the same stock, it might be time to step back. Now listen carefully. This is important. You don't have to sell everything. Just take your original investment out. Now what's left? Pure profit house money. So if the stock crashes tomorrow, you're still winning. And here's something nobody talks about. Selling is emotional. Way more emotional than buying. Because when you sell, you're deciding, am I done? Am I leaving money on the table? That fear of missing out, it's powerful, but discipline beats emotion every time. You don't need to catch the absolute top. Nobody does. If you consistently take profits when things get overheated, you stay in control. And in investing, control is everything. Rule 3, and this one is about mindset. You will lose money sometimes. There is no way around it. If someone tells you they never lose, they're either lying or trying to sell you a very expensive course. Run. Investing is not about being right all the time. It's about probabilities. Even the best investors in the world make bad decisions sometimes. The goal is simple. Make your winners bigger than your losers. In 2026, markets are volatile. Interest rates go up, then down, then up again. Prices move every single day. You'll open your app and see red numbers, and your brain will scream, "Sell, sell, get out." But here's the truth. A loss is only real when you sell. If you've invested in a good company, sometimes the smartest thing you can do is absolutely nothing. Just sit, wait, and let time do its job. Let me give you a mindset shift that can change everything. Instead of asking, "Did I lose money today?" ask yourself, "Has the business actually changed?" Because stock prices move every second, but businesses move much slower. If nothing fundamental has changed, then what you're seeing is just noise. And reacting to noise is how people lose money. Rule 4. And honestly, beginners struggle with this the most. Stop chasing green and stop fearing red. Here's what usually happens. You see a stock going up, 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 straight to the sky. And you think, "I'm missing out. I need to buy now." So you buy at the top. Then suddenly, it drops 5%, maybe 10%, and panic kicks in. You sell at the bottom. Congratulations. You just paid the market a panic tax. Now let me show you a smarter way. It's called pound cost averaging. Simple idea. You invest the same amount every month, no matter what. 100 pounds every month, whether the market is up or down. When prices are low, you buy more shares. When prices are high, you buy fewer shares. Over time, it balances out. And more importantly, it removes emotion. No stress, no guessing. No chasing, just consistency. And this is where patience really comes in. Because investing is not about one big moment. It's not about timing one perfect trade. It's about showing up again and again, month after month, even when it feels boring, even when nothing exciting is happening. That consistency, that's your real advantage. Because most people quit too early or get distracted chasing the next big thing. Rule 5. If someone says, "To the moon," be very, very careful. We've seen it all. Meme stocks, crypto scams, hype projects, big promises, flashy marketing, and then nothing. In 2026, the hype looks more professional, but the trap is still the same. Let me say this clearly. Wealth is built slowly. It's not exciting. It's not flashy. It's actually kind of boring. If an investment sounds like a movie plot, it's probably not investing. It's gambling. And if you want to gamble, that's your choice. But keep your serious money in serious investments. Let's be honest for a second. Everyone likes the idea of getting rich quickly. It sounds exciting. It feels motivating. But in reality, that's not how sustainable wealth is built. Real wealth is quiet. Rule 6. And this might surprise you. Most beginners should not pick individual stocks. I know, it's not exciting. It doesn't feel smart. But the data is very clear. 90% of professionals fail to beat a simple index fund. So what's an index fund? Think of it like a basket, a big basket full of companies. Instead of buying one company, you buy hundreds, even thousands. A global index fund might include Amazon, Google, HSBC, Shell, and many more. So if one company fails, it doesn't matter. You still have hundreds working for you. And here's the best part about index funds. You don't need to be an expert. You don't need to analyze every company, read every report, or predict every trend. You're simply trusting the global economy to keep growing over time. And historically, it has. And in the UK, with an ISA, your profits can be tax-free. For most people watching this, one low-cost index fund is more than enough to build long-term wealth. Simple, safe, effective. Finally, Rule 7. Stop checking your portfolio every 5 minutes. Seriously, just stop. The stock market is the only place where the more you work, the worse your results often become. Checking constantly leads to stress, bad decisions over trading. Instead, check your investments, maybe once every 3 months. That's it. Are you still investing regularly? Are your dividends reinvesting? Good. Now, close the app. Go outside. Meet your friends. Learn something new. Because at the end of the day, money is a tool, not the goal. The goal is freedom, peace of mind, and the ability to live your life on your terms. And constantly stressing over charts takes you further away from that goal. Let time and compound interest do the heavy lifting. All right, let's bring this all together. So if you're feeling overwhelmed right now, that's completely normal. There's a lot of noise out there, a lot of opinions, a lot of experts, but you don't need all of that. You just need a few solid rules, a bit of patience, and the discipline to follow through. If you found this helpful, hit that like button. Subscribe for more simple, no-nonsense money tips, and I'll see you in the next one. Cheers.